In this episode of Investors and Operators, we're talking with Alicia Miller, who is the author of Big Money in Franchising. Today, we're going to be talking everything about private equity, franchising, multi-unit operators as well, and everywhere in between. Alicia, it is awesome to have you here. I would love if you could provide a little bit of context on your background and kind of this intersection between private equity and franchising.
Sure. So my day job is managing director of Emergent Growth Advisors. We work with founders who are looking to bring in private capital help, and also private equity firms and family offices who are looking to make investments in franchising. So this book actually sort of started from it all started from a spreadsheet. I was trying to keep track of which deals had been done, and when people were retrading. And as I was pulling it together and thinking it through, I realized there really hadn't been any broad discussion of private equity activity in franchising, and I felt there was a gap that I could fill. So that's what the book is designed to do.
And how do you kind of segment the book, and really who's the audience for it? And maybe what kind of did you learn throughout the process of putting together the content?
Sure. I guess the audience is really any stakeholder in franchising. There's applications here for founders, obviously thinking about bringing in a private capital partner, but also investors who've never been in franchising before. They can learn from, what's worked and what hasn't worked, for people who've been there before them. Multi-unit operators, private equity is much more of a factor now at the franchisee level than it ever has been. So that's opened up a lot of really interesting liquidity options for franchisees, and that's kind of an evolving space. But also suppliers and even corporate employees. I don't know that there's perhaps ever been a better time to be a really great operator at the corporate level, because with all this PE activity and all the the work they've got to do to hit their business case, if you're a great operator, you've got some really interesting new career options in front of you, including potentially being an independent sponsor. So that, there's just so much going on here. I tried to pick it apart in the book and make a very logical description of, okay, who are the players? What's going on? What's the history been? How does this impact, franchisees, franchisors, others in the ecosystem? And then take you through some of the pros and cons and the techniques that these investors use to grow the businesses. And then, of course, the impact and, things to think about.
So let's talk about the pros and the cons. And
Okay.
and first, what there are different types of private equity buyers. So, for the franchisors, the multi-unit operators out there, what are the different types of private equity buyers, and what are some of the pros and cons of working with each as a capital provider?
Sure. So it's actually a very diverse group of investors. And I think that's one of the common misconceptions, is that they're all the same. I even had a founder tell me once, you know, I, all this money is the same. I just want the best price for my business. So I understand that sentiment, but there are very different types of buyers. So some are traditional private equity firms, which are funded by pensions and university endowments and sovereign wealth funds and that sort of thing. They tend to invest for a certain period of time. They've got a dedicated fund they're investing out of. So the average hold time within that group is about 6 years. The average fund length is about 10. So there's some fairly predictable retrading behaviors you can see just because of their mandate and what they're trying to accomplish. They need to grow it and sell it and return capital to their investors at some point. Whereas family offices are a completely different animal. They are investing out of also a pool of money, of maybe a family or several families, but they don't have a defined time frame to return capital to investors. So in theory, they can hold for much longer. That may or may not be a good fit for what you're trying to do as a founder, right? You may want a second liquidity event in some, time frame that makes sense for you and your family. The rise of independent sponsors has been really interesting in franchising, right? So there's a lot of people looking to invest in the franchise sector, but they need strong operators. So if you're a really good operator, and especially if you've got some experience working with private equity and you speak their language, there's money looking for a home and looking to potentially partner with you. So there's that group of investors as well.
And just to
And
clarify,
yeah,
for independent sponsors, are private equity firms that do not have a fund.
do
So
not
they
have a
don't have
dedicated fund.
$500
Right.
million in the piggy bank to invest in it.
That's right.
And uh, maybe let's keep on going and then come back to that difference in the considerations for working with a funded or a fund list and the pros and
Mhm.
cons of that. But what are some of the other types of private equity buyers?
So there's also private individuals. So we would really probably call those angel investors, right? They tend to come in earlier. And then another really interesting development is limited partners who are making direct investments. So an LP is an investor in a private equity fund. So let's say a pension fund might fit that description. But some of these LPs want to make direct investments and therefore avoid some of the management fees that they're getting by going into a blind pool with the private equity firm. So that's kind of interesting too, to see that they want to make those investments. Uh, I think it just opens up a lot more potential partners for
But
people
are
to.
they investing alongside of that private
They are.
equity
Yeah,
firm?
they are.
So really the franchisor, the multi-unit operator, the owner is going to be interacting with the private equity firm.
Right. Yeah, and they're drafting off of the efforts of that PE firm largely, but they're avoiding, potentially some fees along the way.
Well, let's look into that difference between should a franchisor or multi-unit operator work with a private equity firm or a family office, because I think that difference between their investment timeline is really interesting. And I didn't really think about this till you just mentioned it, but in the recent video shoots that we've done with franchisors who are owned by a private equity firm, I asked them, like, what's the difference between before and after? And the number one difference is everything just got a lot faster, but like in a good way, of like the
In a good way.
tempo just got accelerated times 10. And it was
Yep.
almost like a breath of fresh air. Like they wanted that, but a family office has a different time horizon. They don't have to sell within a certain amount of time. So what have you found in the different conversations that you've had with owners who have done the family office route versus the ones who did the traditional private equity route? What have they gotten from it? What is the feedback you've seen?
Sure. So either choice can put your business on a growth steroid path, right? I think it is true as a general characterization that traditional private equity firms, because of their mandate, because of their timing, and because of who tends to work in those firms and how they do business, tends to move fast. Remember, they come into the business with a business case already set for why they're making this investment in the first place. They already have a pre-list of things that they plan to work on, and they've already got a hypothesis of what they should be focusing on, what they should be prioritizing, what investments they need to make, who they need to add to the team, who might need to exit, and so on. They already know all that stuff, so they move quick. They come in and they of course will have met hopefully the management team ahead of time and will have vetted some of those assumptions. But uh, if you've never worked with private equity before, you put on your seatbelt because they do move very quickly. And they will also move quickly if they find that a path isn't working. If an assumption's wrong, they're not going to continue going down that path blindly. They're going to say, okay, well, let's stop. We need to reassess this, whatever it is, and we're going to make a change here. That speed of being able to turn on a dime and make some changes is also can be jarring to somebody who's not used to it. A family office can be not quite as, doesn't always have that feeling of being on steroids, but family offices are as unique as the families that back them. So sometimes they want to, they're putting together a long hold, and you're still making those same growth decisions and investments, but it doesn't feel quite as aggressive. But the long-term trajectory of the business will be just as much growth. So it's really kind of what your objectives are, and potentially partnering with these private capital players, what style works with your style, and what you're looking to get out of it.
So now let's talk about the difference between a funded private equity firm and a fundless private equity firm, otherwise known as an independent sponsor.
Mhm.
And what should the considerations be for these franchisors and multi-unit operators in deciding, do I go with someone who has a fund or doesn't have a fund?
Again, it depends on what your objectives are. So what the first thing to know is, because there's no dedicated fund for a fundless sponsor, they're not going to be able to move as fast initially, right? So they're looking for acquisition targets. They might start their search firm, and they might take, 12, 18 months or longer to find that acquisition. And they've got some capital partners sort of lined up, but they don't have firm commitments yet, right? So they've got to go find a business and then go through that process. That just takes longer. So it could still be a very strong option, especially for a founder who's looking to fully exit. That that matchup seems to work fairly well, because usually that fundless sponsor is coming in looking to run that business, right? Whereas a traditional private equity firm that's investing out of a fund, they can move fast because they've got funds ready to go. The however is, they're not operators. So they tend to want to come in and back a management team. So they're going to be less excited potentially about your business if you, as the founder, are leaving. Whereas an independent sponsor, that might be exactly what they're looking for. So if you are a founder looking to exit, the best thing you can do, fully exit, the best thing you can do is make sure you've got a team underneath you that can take over, so that you keep your options open, right? You don't want to close the door necessarily to traditional private equity who won't be as interested in that full exit. But if you've got someone waiting in the wings to take over for you, then that gives them the option to do that, right?
Shifting over to kind of life before a deal.
Mhm.
Um, IFA was recent, and I'm sure a lot of founders, a lot of owners were approached by private equity before, during, and after. Um, what are the key questions that owners need to be asking themselves and preparing for before a private equity deal?
So I always advise starting way in advance. Okay, before you even contemplate bringing your business formally to market, you've got to take a beat and drill into what your objectives are, what you're looking to accomplish, and take some time to analyze how far away you are from your actual goals. Because in my experience, there are often opportunities to make some changes prior to coming to market that will end up strengthening the business, strengthen your EBITDA, make your franchisees happier. And if you back it up about a year or two in advance, you can get some things done in advance. And it's not just about getting your data room ready to go. I mean, you should have all of your financials, your FDD receipts, and of course, all that stuff sort of gathered and kept constantly updated. That's just sort of like business hygiene. But you might need to be tweaking your franchise development approach. There might be a gap on your leadership team. For example, as I just mentioned, if you're looking to exit, okay, you need to bring in somebody underneath you to be potentially ready to step into that role. Um, if you're not the only owner in the business, you've got to really sit with your other owners and vet your collective objectives, because they might be different. And you don't want to get into the middle of a sale process and have a major disagreement on your hands of who wants what and what they're looking to get out of a transaction. So you got to kind of figure that out ahead of time. You might want to, there might be other products you want to launch ahead of, prove out another revenue stream. Um, Very often there's weakness on the finance team, and bringing in a fractional CFO a couple years ahead is a smart move and not that expensive compared to, not having one. So there's stuff that you should be doing in advance for sure. And unfortunately, I think many founders will sort of start this conversation and find themselves, they have an LOI like 2 weeks later, and now it's like, okay, I didn't realize I was going to get here this fast. Now what? Um, and they also may not realize that, just because an LOI is put out doesn't mean that deal's going to close. These guys look at a lot of different things, and their interest can go hot to cold very fast. So if you're not ready for that, you can spin your wheels a lot talking to potentially um, capital partners that aren't going to end up being the right fit for you, but it
Yeah.
churns management time and you're taking your eyes off the business while you're doing that. So just
Some
advanced work is smart.
I forget who told me this, but they're like, you might not have a plan for private equity, but private equity has a plan for you.
Well said.
And if you don't have a plan, well, get ready because you're just going to have to follow theirs and you're going to have less negotiating leverage and less awareness because they move fast and they have options. There's a
Yep.
lot of capital out there chasing deals. Um, let's kind of think through what is the playbook that private equity runs with franchisors and multi-unit businesses.
Sure. Well, franchising at its root is a growth engine, right? That's why people like franchising. It is a model designed around how to grow faster using other people's money, franchisees, investment and energy to grow the business. So at its core, somebody who's coming in as a growth investor, which is the majority of the deals that are done, is looking to accelerate growth. And to accelerate growth in a franchise model, franchisees have to be, reasonably satisfied, if not super excited about their prospects so that they continue to add units and new franchisees come in. At its most basic, that's what they do. Now, what that means to a particular business might vary. So some businesses the investment might be, okay, we're gonna work on franchise development. We're gonna really invest in this team and add growth that way. Others might say, nope, that's nailed. What we really need is a stronger tech stack. We need a great loyalty program. We need a way to connect with our customers better. Some need to work on their marketing and, to raise same store sales. Some might need to refresh their, if it's a food business, maybe the menu needs to be streamlined a little bit. There could also be opportunities with suppliers to, improve the supply chain, to bring some costs down for franchisees, to fund through rebates, corporate initiatives that maybe didn't have that set up before, so they didn't have a way to fund corporate initiatives. So that could be another area. And then, of course, opening up new markets. So often a larger system will trade hands in order to get them working with somebody who's got experience going into international markets. That's often a very common inflection point. So those are the kinds of things that they tend to invest in.
What types of companies, or actually, let me say this a different way. What is the typical size and shape of franchisors and multi-unit businesses that are ready for private equity? And I know there are different types of private capital, but how would you kind of approach that?
Sure. So it used to be said that you needed at least 2 million of EBITDA to attract private equity. I think what we've seen is that franchising has gotten fairly picked over at this point. To be honest, there are more than 700 brands that have attracted private capital, either at the franchisor or the franchisee level, or both. And by my count, there's almost 400 private capital firms now with franchise experience. So because so many of the largest brands are already spoken for, it's forced more private capital partners to go down market into smaller and smaller brands. The smaller the brand, the bigger the lift, right? And the longer the time frame to get any sort of real payback that's meaningful. Bigger funds have to write bigger checks. So it's harder and harder for them to do that. The way that they've addressed that problem, by and large, is either they are willing to pay a higher multiple to acquire a larger company, or they handle it through platforms, because platforms can provide the infrastructure to helpfully lift those smaller brands, and they can do a series of tuck-in acquisitions to expand. So yes, they're smaller acquisitions, but in the end, because of the multiple arbitrage you get from combining all these things together, it still is a worthwhile endeavor for them to do. But it's harder and harder to find those unaffiliated quality brands with scale.
Have you found any private equity firms that have a small cap franchise strategy or like a minority growth strategy? And it's like, all right, when they actually are ready to become part of the larger fund, that they have that?
Yeah, so Riverside's an example of a PE firm that has a dedicated microcap fund that they're investing out of. So they can make these smaller investments, and that's what the fund was designed for. Um, Family offices and independent sponsors can often get more creative on minority deals than a traditional PE firm. Traditional PE usually wants majority because that's part of their mandate and their duty to their shareholders. So if they make a minority investment, often there's sort of a right of first refusal, or they have the first opportunity to acquire the majority stake later. That's the way they handle that.
What are some of the established funds that do minority investments that might be either minority, particularly on the smaller cap side?
That's a very small list, and especially when it comes to those with franchise experience. Most of the most active PE firms will wait until if the entity's bigger. Now,
Mhm.
there are what's the other thing that they're doing that's interesting is um, if they can't find a franchisor of the right scale, they are increasingly willing to consider multi-unit franchisees because you can build a pretty tremendous scale if you've got a large system that's got hundreds and hundreds of units. Um, you can start consolidating those units and build a business of scale. So that's why you're seeing investors coming in, like Garnet Station Partners, as an example, has come in and has acquired units in some franchise brands. Exaltare Capital is another one that invests at the franchisee level, uh, as well as the franchisor level. Both of those firms do. So Planet Fitness and Orange Theory are two examples of franchisors where more than half of the units are actually owned by private equity firms. So there's a lot of activity under the surface at the franchisee level that didn't used to be there.
What uh what types of potential conflict has that created when you have the multiple owners under the master franchisor, and it's like they might have different approaches, like no, strategy should be this, not this, and
Right.
guess what, we own the northeast and you own the southeast. Like how does it actually work?
Well, it's been very interesting to watch how this has transformed some of these brands, right? So what ends up happening is first they let in their first private equity firm at the franchisee level, right? We've never had one before. We like that they're well capitalized. We know that we probably want to see a little bit of consolidation here. But there's this angst around, well, how much is too much? This changes the power dynamic a little bit. And so they kind of get comfortable with private equity coming in. They see the benefits of working with PE who can fund expansion, right? They want to grow the system. But then at some point they realize, oh my gosh, these are very different franchisees than our typical franchisees. No matter how data based or how numbers comfortable a franchisee is, a PE firm as a franchisee puts that on steroids, 10x, right? So what ends up happening is if there's any sort of disagreement with how the franchisor is managing things, franchisees can always come together and lobby, for change or lobby against change. But when those franchisees are PE backed, they move faster and they come to that conversation armed with a lot of data, which then can put the management team back on its heels a little bit. If you're not managing that relationship really tightly and keeping everybody on the same page, it can end up being a lot more confrontational. And they can say, look, this area, for example, marketing, we are not headed in the right direction. We're not recovering from COVID the way we need to. You guys aren't doing the right thing. And here's the data that proves it. Okay, that's a very different conversation. And some of these management teams, I think, have had to make some adjustments in how they approach franchisees. I personally see this as positive, because you know, how things affect franchisees should be taken into consideration. Um, and I like the use of data to make a business case. So I'm on board with it. But I think for many systems, it is sort of another inflection point in their growth,
Yeah.
when they get to that point.
When a when a franchisor is getting ready to potentially sell their business, at what point do they start to talk with the team, management team, others about what this is going to look like? And have you seen any examples of that where it really worked well, and maybe some cautionary tales when it didn't work well?
Yeah, I mean, I think that you probably are going to need to bring them in at some point early in the process. And look, the first thing you've got to do is anyone who's going to be presenting needs practice doing that. So have your VP of marketing present to the board, once a quarter. Just get them ready for that kind of conversation long before you're ever contemplating bringing in an outside investor, just so they can get that practice, and can get some feedback. Remember, you're telling a story about your business. And so everybody on the management team needs to sort of be briefed on what that story is, because it's very easy to get lost in the deck. I've got a deck sitting here on my desk that's 67 pages long, and 2/3 of it are spreadsheets, right? You're just going to get in the weeds really fast. So having a consistent message across the management team of what the opportunity is, what that culture is like, what things that the team believes should be areas of investment going forward, kind of having a common point of view on that is good for your business generally, but certainly would be good heading into a transaction. And remember, when you bring in an outside investor, if you're, most likely you're going to be creating a pool of options, for the management team to participate in. So ideally, they should be pretty excited about that. And it opens some new opportunities for them um, to create wealth as well. So
Well, let's dive into that. So, for the management teams, how should they look at money? And so, if you, for example, let's say this is a business that has 5 million of EBITDA and it's going to trade at 10 times, just for simple math. I'm not saying this is what the market is, but for a business that has 5 million of EBITDA, let's make it easier. 10 million of EBITDA trading at 10 times. What should the management team be looking at for a pool of options, or what does life look like for them in terms of money, equity after the deal? What are the key components of it?
So I think the biggest thing is that many management teams have never been exposed to this information before. So they see businesses trading and they don't realize that, if you are traded today and as a result, there's an options pool for the management team, right? So if you trade today at 5 times EBITDA and you sell in 6 years for 10 times EBITDA, you just made money. And, in most cases, the entire management team is not necessarily putting money into the deal. Usually it's kind of the more senior people who are putting money in as well, so they can keep interests aligned. But there's a multiple expansion opportunity that you just don't have otherwise, unless you're working with a private capital firm to grow the business and to create this option pool, right? The founder might not have contemplated creating an option pool before this event. So the management team can get really excited about this. And it also is great for retention. I mean, as we know, is sort of a war for the best talent right now. And with all these firms pursuing a growth objective, they need great operators. They need, a really great head of marketing. They need a great head of ops. They need somebody who understands what great operations looks like and can actually deliver on that. So it puts hooks into your management team so they're not tempted to go jump to something else, because they can see, there's a long-term opportunity here for them as well. So
Well, let's dive deeper in that. Let's and it's okay if they're rough numbers. So for a company that does have maybe 5 million of EBITDA and they're getting ready for a transaction, what does that mean for the senior management team, CFO, COO, et cetera, of how much should they be thinking about writing a check for in this next deal? And also people who might not be on the at COO, CFO level, you know, what should they have an option to invest, or what does that actually mean for money to them? Or what's the message to the CEOs who are the owners? Like, hey, you need to get ready for this. Here's how to think about it.
So I think that first, let's start with what you said second. I do think that founders who are considering a transaction should think about this ahead of time. So that might be something on your list that what you're looking for. Not every private equity firm or family office may be interested in opening up a pool of investment. So let's say 5% of the deal could be funded by management, right? So they get a stake in the business. But not every PE firm is going to want to open that up. The same thing is true with a role. So if you're a founder, let's say you own 100% of the business and you want to roll, a pretty sizable amount. Let's say you want to roll the whole thing. That's happened. Not every firm's going to let you do that. Some are going to say, well, we've got to create room for our own investors here. So we're only going to let you roll 30% forward, right? So these are that's why you need to really think about this ahead of time to know what you're asking for so that you can ask those questions early in the process. You don't have any surprises. But I would say in terms of a pool for management, somewhere around 5%, 10% is probably, I think, pretty standard.
And what does that mean for when do they start to create that? And should they even create it before they engage an investment banker to go through a process, or like, what's the timing of that?
Well, if you want to give your employees, opportunity to invest in the business, you can hire a banker to help you do that before you ever attract outside capital. So that's a different conversation, right? If you want to sell equity in the business or you want to give equity away in the business, that's something to consider ahead. But normally, if you haven't done it to that point, it would be part of a transaction, your first institutional capital in.
And is it common for what, 5% or 10% as part of is there actually, maybe a different question is there a level that is unattractive for a typical private equity investor of like, I like the business model and financials, but this cap structure is not attractive to us?
That depends on the firm. Although I would say if they're not making at least a little bit of headroom for the management team to have a small stake in the company, I would question their strategy. It's going to be tough to retain people that way. And look, they may decide that, let's say they've given a little bit of equity to the head of operations as part of the deal, and then they decide that's not the right person going forward. Okay, well, that person's still an investor in the business, right? So it is not tied to an employment contract. Typically, they are separate. But yeah, if they're not making some sort of headroom, then I would say, where's the alignment? Because the team's going to be trying to drive this thing forward and grow the business. And again, tying it back to, the only way you can grow it long term is if franchisees are happy and satisfied. Well, the best way to align your management team with what's best for franchisees is to make sure they've got skin in the game too, right? Because franchisees have a lot of skin in the game. They've invested their retirement. They might have their home. There might be a personal guarantee against their home. And if the management team doesn't have any stake in the business up to that point, then it's hard to keep those interests aligned.
Speaking of alignment, after a transaction, what does good alignment look like? And what do owners need to kind of prepare themselves right now for, like in the first year?
Things move faster, as you pointed out. I think another thing to consider is that franchisees in general, human beings, don't like change. Change is scary. And your business is going to go through these natural inflection points, regardless of whether you bring on private capital, right? When you start out, your first, 10 or 20 franchisees, the business is still kind of coming together, right? It's not a fully formed, entirely proven model quite yet. But by the time you get to, 100 units or whatever, now you've got a very different business. And as you may have seen, some franchisees sort of mourn the old days. They liked picking up the phone and calling the founder and getting that guy on the phone. They liked that personal relationship. And the business will naturally evolve to something that looks more corporate, for lack of a better word, as the thing gets bigger. But especially as it goes through ownership changes, because the first transaction, the founder is essentially choosing the partner, right? And cultural considerations might be part of the equation. But by the time it trades a second time and a third time, now we've got professional management teams coming in, who are under the private equity firm potentially who runs it, and there are culture changes each time that starts to happen. And franchisees, this can be very challenging for that relationship with franchisees. So the biggest thing is to anticipate that change is hard. Some changes may be very positive for the business, and some changes franchisees might be more skeptical of. So if you don't have sort of a robust communication mechanism in place ahead, managing through all those changes is going to be challenging. So ideally, you have a franchisee advisory council or some mechanism to take that feedback, digest it, and then come back to the franchisee community in some organized way and say, look, we heard you. Here's what we heard. Here's what we're going to do differently. Here's what we don't agree with, and here's why. So that there's a mechanism to process these changes and questions long before a transaction comes up. That same group can be very useful for continuity over time, and sort of managing some of the franchisee pushback, because, as we know, not all franchisee pushback is reasonable. Sometimes they just don't like it. They don't like change because they don't like it. And you've got to have a way to manage that.
I love that. It's such a truism about life, about being resistant to change. And it's almost like the need, like, how do we practice getting used to change in our
Yeah.
day-to-day lives and in the business of, we naturally, as systems get more complex, we naturally want stability, even down at the family unit level with our kids. Like, I want lunch is going to look like this, dinners look like this. We're not going to change it. I got other things. But it's interesting, just the skill set of how to be adaptable.
Yeah. Well, yeah, and think about businesses that continue to scale over time across all of these tremendous changes that we're all living with in our modern world. The businesses that are the most resilient have resilient relationships, have trust, have good communication, and a willingness to be a little uncomfortable with change and to manage through it together in some sort of productive way. If you've got a culture where people just fight change tooth and nail, I don't know how you get through in our modern world with that mindset. That's probably just not a productive mindset within today's business world, right? You've got to be a little more flexible than that. But on the franchisor side, you've got to show, active listening too. You can't be, it's kind of like being married. You ever talk to your spouse and they're going, uh-huh, uh-huh, uh-huh. And they're not hearing you, or your teenagers, in my case, in my family. If you don't feel heard, then, you're already kind of now coming back to, well, why aren't you listening to me? It's hard to have any sort of real discussion if you're not having that open exchange. And franchising is about relationships, effective franchising. So I think that's probably one of the bigger challenges. One of the surprises I took from the book was just how squishy this gets. you know, I don't know that private equity practitioners are known for their soft skills. They're known as, clinicians. They invest and they grow businesses, and they follow a plan, and off they go. But to be successful as a franchise investor, there's a lot more attention has to be paid to the cultural aspect, to the communications, to the relationship in order for it to work.
Yeah, I love that part, especially on feeling heard. And it makes me think, I've been listening to some more parenting books recently, and a lot of times it's like, one of the things that they were talking about is communicating to the kids. It's like, hey, I'm also trying to figure this out, and I'm not perfect.
Right.
and and I'm trying to do the best I can. And it's interesting because that speaks to the need to over communicate with the franchisors to the franchisees. And part of that type of communication builds trust. And it's not just coming from high, like this is how it's going to be. It's, hey, we're trying to grow this together. And it's a mutually trusting relationship.
Yeah. Yeah. And, in franchising, traditionally, some of the best ideas have come from the field and have come from franchisees. So having that mechanism is important for lots of reasons. But yeah, I mean, you've got to be a little bit, allow yourself to be a little vulnerable too, which can be hard for, type A personalities and people who are used to, saying they have all the answers. Just like with your kids, it's okay to say, hey, I have no idea what I'm doing here. I'm just trying to figure this out too. This was an unexpected thing that happened. We're going to muscle through it together and we're going to figure it out. This wasn't in our initial plan. And here's what we know. Here's what we're still trying to figure out. Here's how we're going to handle it. And, let's figure it out together. I mean, COVID was a great example of, we just all had to sort of come together and figure it out. And some of the solutions weren't elegant and weren't well planned, but brute force got it done and we got through it. Right.
Yeah.
So that can happen.
I'll have to delicately word that to my 4 and 7-year-old. This wasn't part of the plan, and this is still an experiment, but
Right.
we'll get you in the right direction. So,
Yeah.
shifting over to maybe some of the cautionary tales within private equity's history of investing in franchises, like what are some of the more, maybe even the more public examples, but the lessons from those examples of where maybe private equity did not do the right thing, and or just friction in the relationship, and what can people learn from it?
So I think the biggest learning that I took from it when I was doing the research was the approach has really evolved. These are smart people who are capable of learning, and they have learned what works and what doesn't. One of the learnings collectively that private equity has had about franchising is that turnarounds in franchising are one of the toughest assignments in business. They are not for the faint of heart. They take a long time. They're expensive. And it's not, if you're a private equity firm and you're buying, say, a factory, you can always pick that factory up potentially and move it to a lower cost market, right? So that's a tried and true method to reduce costs. But in franchising, you've got to get the franchisee community on board with what you're doing, with whatever changes you're making. And even though there's a contract in place, franchisees can be, they can be challenging. They can assert themselves as a group and be difficult if they want to be, if they don't agree with the changes that you're proposing. So I think some of the mistakes, especially in the early days, when PE first came into franchising, were around just not understanding how difficult the road was going to be, not understanding this dynamic with franchisees, being overconfident in their ability to turn a system around. So they might have gotten a fairly good deal on a business that looked like it was, going to hit the rocks, but it took a lot more work to fix the business. So firms that were so like as an example, Bain Capital, its roots are not investment banking. Its roots are consulting and operations. So Bain was able to go in and, for example, buy Burger King in, I think, 2002, if I remember correctly. And that was a turnaround, right? But they had the operational chops to go in and say, okay, we know how we're going to turn this business around. And they did, and they successfully then did an IPO later on as a result of that. They were able to kind of turn that situation around. But PE firms that didn't have that sort of operating capability or didn't have strong operating partners as part of the formula struggled. And I think we saw that combined with over leverage, especially in the restaurant sector, just put a lot of firms back and they never got out of the mess. Friendly's being a really easy example, where that was over leveraged. It went through a string of owners and finally it was just too much and they weren't able to turn the business fast enough. And now I think it was bought by Amici Partners for about $2 million. And they're trying to sort of relaunch the brand, but it's basically a start from scratch again, almost.
Do you think that franchise investors are staying away from the turnarounds in this next cycle, or that they learn their lesson? They're like, actually, this is where the opportunity is because we learned our lesson through over leverage and poor operations, and now we're going to go into this buying at attractive prices, but we've learned the lesson and now we actually know how to do this right.
think the answer is both, very firm specific. So Subway is a great example. That's definitely still a business in turnaround, right? They've got tremendous expansion opportunities, especially internationally. But they've got some struggles here in the US. They're going to still have to right size the business here. There's still probably too many units and it's going to be painful. But Rourke is experienced in the sector, in the restaurant sector, and is willing to take a bet on being able to pull off a multi-year turnaround. And they've already shown some good progress, right, on their turnaround plan. So it's not as risky as if they were starting and coming in with a brand new plan for the turnaround. All they really have to do is kind of like continue to execute the existing plan. But I do think that it has put investors off, especially in a higher interest environment, to taking on big projects and small projects. That's why some of these emerging brands, if you don't have, as an emerging brand, even though you're small and therefore, technically inexpensive to acquire, if it's too much of a lift, most investors will just wait or will find something better. They don't have much of an appetite for those turnarounds. I think independent sponsors and large franchisees who have great operating chops, who then go by a whole system, that's where we're seeing, I think, more appetite for that kind of work, right? There's lots of examples of that. So I think that's where we're more commonly going to see it.
So the firms might invest behind the strongest operators to go off and do those turnarounds as opposed to buy it and they hire outside operators.
Right. Or the operators themselves go and acquire whole brands. So like trying to think of an example, like Gala Capital Partners, right? So he's an operator, he's a multi-unit operator in several franchise systems, but he's also gone off and um, put enough capital together to go acquire entire brands as well.
Yeah.
But for him, he's got a longer term horizon. He doesn't put debt on the business, so he doesn't overburden them. And he's an operator, so he brings more hands-on focus than a traditional private equity firm would in that situation. So a turnaround for him is something he might is willing to get involved in, whereas a larger firm says this isn't going to be a fit for us.
Yeah. Well, maybe kind of bringing it to a close here. What's the reason why you do what you do? Why do you focus on this particular intersection between private equity and franchising and multi-unit operators? What keeps you going?
I love deals. I love working on deals, and I love working with founders, entrepreneurs. The private equity teams I work with are amazing. They're fun people. They want to build big businesses. And I'd like to see more really strong positive outcomes in franchising. And for many firms, bringing in the right partner at the right time just takes the business to a whole different place, and expands people's thinking and expands the options in ways that they just otherwise wouldn't have had. So I love working in this space.
That's awesome. And actually, maybe one last question, which is, what do you see as the future of private capital investing within franchising in terms of maybe the percentage of deals that'll be like, it's going to be more independent sponsors versus funded, or those types of overall insights? What do you see as kind of like the future in the next maybe 5 years?
So there are still some quite large brands that are unaffiliated, and they're going to continue to get pounded by private equity phone calls, who want to potentially try and do something with those businesses. That's not going to change. But most of the large brands have already, that are interested in taking capital, already have. So the deal making percentage, I think, is going to be higher on retrades, in terms of the absolute dollars scale is going to be on retrades, with a couple of notable exceptions like Subway, it's trading for the first time. And there's a couple of other large businesses that have never taken private equity, right, that are traded in the family. At some point, somebody in the family says, I don't want to do this. I don't want to take over the business, and then it'll trade. But I think we're going to continue to see the number of deals in smaller companies will continue to be active, very active, because there just aren't a lot of opportunities. And more firms are getting comfortable with those smaller deals, and through platforming can pull it off. They can justify writing those smaller checks because they're putting them into a vehicle that they know they can grow and get the benefit of that multiple arbitrage. So, and I definitely see more independent sponsor kind of activity for sure.
Where they partner with a larger, well-capitalized
Mhm.
firm that might back them, and then they
Yeah.
do the heavy
And
lifting.
family offices. Yeah. Yeah. So think of it as like a hybrid. Yeah. So like an independent, let's say a CEO of a restaurant brand, finds an attractive target and then partners with a firm to then go acquire this business, and then that guy's going to take over that business. I see a lot of that kind of activity, and I think family offices are getting smarter about um, partnering with operating partners. It's almost like they're taking on the PE model, right? So a lot of PE firms will have operating partners, named operating partners in their firm to help them sort through some of these things and potentially to step into these roles. Whereas family offices traditionally haven't had that, but I see more of those kind of partnerships happening. So that to me seems like kind of a hybrid model.
That's awesome. Well, we have covered a lot of ground on this episode, and I appreciate you taking the time for it.
Sure. No, thanks for the opportunity. It was great talking to you.